Hey, Mark here. In this video, I wanted to talk about the 1% rule when it comes to real estate investing. Now, this is a macro guideline, but it's a quick, fast rule when you are considering the numbers of a property that you might want to keep for your own rental house portfolio, or if you are selling to investor buyers for their rental house portfolio, because we're marketing to find these deals and then we're marketing to try and get as much as we can for these deals if we are selling them. Now, if we are hanging on to them, we want to know what a good deal looks like. That's what this video is about. And we're talking about the 1% rule when it comes to real estate investing. So what is it? It is so simple. I'm going to do some simple math here. Let's say you find a house that has an ARV after repair value of $100,000. Okay, simple math here. Your market is probably different, but you get the idea. If you can rent that house for 1% of $100,000 each month, chances are that's a pretty good deal. If the other things that you're looking for within your criteria, within your housing alert software is getting checked as well. So what we're looking for, obviously, are areas that we're interested in potentially keeping those properties that we find or supplying those properties to investor buyers that we know are looking for properties for their rental house portfolio. The thing is, they're going to have those houses for a long time, potentially make money for a long time. I want you to be able to do that when the time is right and when the numbers are right. So if you can uncover a house that has a $100,000 value that can generate $1,000 of rental income each month, chances are that's a pretty good deal. Now, you can adjust those numbers as they see fit, because I'm sure if you're like me, if I was watching this, I think, well, then my numbers are different in my market. That's fine. 1% of whatever numbers are accurate in your area. That's just a macro rule here. But when you are uncovering a number of deals within your marketing to maybe wholesale properties to investors or to wholesale properties to investors that are keeping the properties, well, there's a different value play there. If you're giving somebody a property that you know has value, you're marketing and packaging this property, you've gotten the deed, you are then marketing this property, it's important to understand why they might find this valuable so that you can get more money for that property. Just makes sense. We're marketing to get things, we're marketing to sell things. The better we market on both ends, the better our chances for success. Now, of course, in the bigger macro area, we want to know that we are focusing in on areas where people are migrating into or where there's at least demand for both rentals and for house buyers. That way, if you are wholesaling, at least you know that they're wholesale buyers that are interested because they've got people on their buyers list. If you've got buyers that are holding on to these properties, that's a good thing too. So as we are pecking down then, using your housing alert software, then you can be working the magic within that program so that you can find the areas within the states, within the neighborhoods, have the amenities, have all the things that you want so you can generate leads accordingly and then work the exit strategies that you've got in place. But I wanted you to know that the 1% rule is something that should jump out at you. If you are focusing in on areas where the 1% rule applies, it could be that those houses might help you with your wealth creation because you're holding on to them for the long term. Now, you might be saying, Mark, the 1% rule doesn't work where I live. Well, let me just share some insight here. When I started in real estate in the 1980s, one thing that I would hear, especially from some of the people that have newsletters that we would get access to and read, is people would say that, well, it doesn't work in my area. Well, guess what? In their area, it might not have. And what did those newsletter writers say back in the day? They said, well, then go where it works. Well, fast forward to now, virtual investing. You can get on Zillow, you can find all kinds of different places. You can learn all kinds of things. You've got your housing alert software. You've got all kinds of great access to information at your fingertips, right? So you can be virtually investing wherever the numbers work best for you. So if there's a migration going from one state to another, you don't have to move. I moved from the San Francisco Bay Area in 1992 to Phoenix, Arizona, because that was where a lot of the numbers worked. So I actually walked that talk when people said, well, go where it works. Well, I did. It was very expensive where I was. I went to where it wasn't as expensive. Nowadays, we don't have to do that. Virtual investing. So if you're thinking, I want to target some areas because I know there's a lot of great wholesaling activity going on there because you want to be able to generate some quick income that way, fine. But if you're saying, but those areas, the 1% rule doesn't really work. Okay, well, where does it work? And do they have property management companies there? So you don't have to manage these properties? And could it be that there's demand there for both buyers and renters? You get the picture. The point is the 1% rule is a really nice way to be able to know if a property has the chance to be a good deal from the financials. Then you can work out the rest. I'm Mark. Until next time, I'll share more with you soon.